Welcome. Thank you for listening to our session on some of the key provisions contained in the CARES Act, which was signed into law on March 27th of 2020. I'm Brian Ellenbecker, one of the financial planners at Shakespeare Wealth Management, and I will be taking you through today's presentation. In this session, we will focus on the key provisions of the CARES Act that pertain to businesses and business owners. Some of these new rules do get pretty complicated. My presentation is just an overview. If you'd like to discuss the new rules in more detail and how they may pertain to you, please do not hesitate to call us. We'd be happy to discuss them with you further. In today's session, we'll cover several of the key provisions from the CARES Act. These include the Paycheck Protection Program and the associated forgivable loans that come with that. We'll talk about the Employee Retention Credit, payroll tax payments that can be now deferred, and a few changes to several key provisions like net operating loss carrybacks. One of the most significant provisions for business owners in the CARES Act is the Paycheck Protection Program, which is also paired with a forgivable loan provision. So the Paycheck Protection Program is a loan program that allows lenders to issue Small Business Administration or SBA 7A small business loans up to a maximum of $10 million or 2.5 times the average monthly payroll costs over the previous year to any business that has fewer than 500 employees. Now, the definition of a business does include sole proprietorships. It also includes food service businesses that employ fewer than 500 people per physical location. So it is a fairly broad definition. If you acquire a loan, the loan proceeds can be used for any number of expenses, including payroll costs. Included in the definition of payroll costs are wages, bonuses, commissions, employer group benefits and retirement plan contributions, and state payroll taxes. Group health insurance premiums and other healthcare costs are included. Rent, mortgage interest, not including prepaid items, utilities, so things like water, electric, gas, internet. You can use transportation costs. You can actually even use business interest on loans that you incurred prior to February 15th of 2020. The loan forgiveness provision contained in the Paycheck Protection Program is one of the most attractive aspects of it and what is really going to draw people to it. So the amount of the loan that is eligible to be forgiven is the amount spent during the first 8 weeks after the loan is made on the items that you see on the screen. So the first item is payroll costs, and we defined what's included in payroll costs on the last screen. But it's important to note that only compensation up to $100,000 per employee can be counted. So if I have an employee that makes $150,000, I can only include $100,000 of their compensation. I can also spend the loan amount on rent, as long as that lease was enforced prior to February 15th. I can spend it on utilities and transportation, as long as those services were in place prior to February 15th, and then also group health insurance premiums and other healthcare costs. Now, the loan amount that's forgiven is limited to the eligible amount, and the eligible amount is determined based on the expenses I just talked about, and then you multiply that eligible amount by a percentage. The percentage is calculated by dividing the average number of full-time employees per month that were employed during the covered period, and you divide that by, and this is the borrower's choice, this is your choice as to what you want the divisor to be. It's either the average number of full-time employees per month that were employed between February 15th of 2019 through June 30th of 2019, or the average number of full-time employees during the period January 1st of 2020 through February 29th of 2020. Now, I know that's a complicated provision. I wanted to get it out there so you hear it and you understand what it is, but I expect that there are questions on that. So that's something either your accountant can help you calculate, or we can have a discussion around the specifics of your business and try to help you work through these calculations. But it's important to understand that there are tests that need to be met. It's just loans aren't just automatically forgiven. Now, if you don't meet that requirement, the employee requirement, then the loan forgiveness is reduced on a pro rata basis. You'll actually also incur additional reductions on the forgiveness if employees with compensation under $100,000 have their compensation cut by more than 25% when compared to the most recent quarter. There's a few other really big provisions that, again, make this loan program very attractive. So any debt that is forgiven is not included in taxable income. The maximum interest rates on the loans issued under this program is 4%. However, guidance just issued by the Treasury Department to borrowers has actually set the loan interest rate at 0.5% for loans that are currently being made. The Act allowed for a maximum length of the loan of 10 years, but here again, the Treasury Department announced changes or announced the current loan program, and the current loans are going to last for a period of 2 years. So 2-year loans with an interest rate of 0.5%. Payments can also be deferred. They'll be deferred no less than 6 months and no longer than 1 year. So the specifics of the loan will dictate how long you can defer your payments. So some really great provisions here. Again, this is a really new and really complicated aspect of the CARES Act. It's important to understand that this is out there, and if this is something that you think you would like to try to qualify for or take part in, you can let us know or reach out to your lender if you have an SBA loan lender that you work with. And even non-SBA lending banks are also eligible to make these loans. So there's a lot of help out there, and as more and more information comes out in the next few days, we'll be able to provide even better guidance for you. The next key provision is referred to as the Employee Retention Credit. So because many businesses were forced to either reduce their hours or close their doors altogether, it's caused some hardships for sure. So as an incentive to encourage businesses from making further layoffs, the CARES Act is providing a new payroll tax credit, which is referred to as the Employee Retention Credit. So the credit is equal to 50% of wages paid to each employee up to a maximum of $10,000 of wages per employee. Now, with a business with 100 or fewer employees, all wages count towards this credit. For employers with with over 100 employees, only wages paid to individuals who are not working during the shutdown are eligible to count towards the credit. And it's important to remember wages do include health benefits in both of these definitions. So to be eligible for the credit, the operations of the company need to have been fully or partially suspended due to government intervention because of the coronavirus, or revenue in 2020 was less than 50% of the revenue from the same quarter in 2019. And then for businesses that actually meet one of those requirements, you'll continue to qualify for the credit until the earlier of December 31st, or you either have a quarter without a government required suspension of operations or slowdown in operations, or the gross revenue from the current quarter exceeds 80% of gross revenue from the same calendar quarter in 2019. So whichever one of these things happens sooner, that's when you no longer remain eligible for the credit. It's important to note that not all businesses are going to qualify for this. If you do participate in the Paycheck Protection Program, you would not be eligible for the Employee Retention Credit. So essentially, the government's saying we're giving some generous provisions here to business owners, so they don't want you to double dip. Basically, it's you got to make some choices as to what you think is going to best impact your business. The last big provision and new provision here is the ability to defer payment of your payroll taxes. So for payroll taxes that you accrue from the period of March 27th of 2020 through December 31st of 2020, you're actually able to delay payment of those payroll taxes. So if you choose to delay payment, 50% of the payroll tax liability is due in December 31st of 2021, and then the other 50% is due on December 31st of 2022. So you actually, other than payroll tax liability that was accrued for the first quarter of the year, essentially, payroll taxes for the remainder of the year do not have to be paid at all until the end of 2021, half in the end of 2021, which is a year, more than a year away, and the other half is 2+ years away at the end of December of 2022. So some generous deferment of payroll taxes. This also includes, for those of you that are self-employed, self-employment taxes are considered part of the payroll tax definition. Again here, just like the employee retention credit though, this provision is not available to businesses who participate in the Paycheck Protection Program. The last group of provisions are all related in that it allows businesses to claim refunds for past items. So the first, net operating losses. Carrybacks have been brought back and are now allowed for tax years 2018, 2019, or 2020. And those operating losses can be carried back up to 5 years. Net operating losses are also able to offset up to 100% of taxable income in 2018, 19, or 20 instead of the 80% threshold, which was prior to this law. The minimum tax credit. Corporations are able to claim 100% of their AMT credits in 2019, or 2020 for that matter, but 2019 will give you immediate cash. And you also have the ability to deduct interest expenses, or more of your interest expense. So the limitation on the deductibility of interest expense was increased from 30% to 50% for tax years 2019 and 2020. So how are these all related? Well, all of these changes allow you to amend your prior year's return to claim refunds for any of these items you may have, and really help enhance your current cash flow picture for businesses. The reason this strategy tends to be very popular and a lot of businesses appreciate these types of changes is that they're able to amend past returns, you claim a refund, and that's going to inject more cash into the business now, presumably during a time of need. The last item I want to talk about is what's referred to as Section 139 disaster relief. Now, this is technically not part of the CARES Act itself, but it is a potential planning opportunity for certain businesses where employers want to assist employees with certain expenses. And these expenses that I'm referring to are often referred to as qualified disaster relief payments. So what these allow an employer to do is pay money to an employee tax-free to the employee and fully deductible to the employer, assuming these payments meet several qualifications. So first of all, there's a qualification on use of funds. So the employee needs to use the funds they receive to either as a reimbursement or to directly pay any personal expenses, family expenses, living expenses, funeral expenses, or it's to repair or rehab a personal residence or contents attributable to a disaster. That second one is less likely to apply in the coronavirus cases, but the first one, personal expenses, family expenses, living expenses, potentially funeral expenses, those are things that could potentially be attributed to coronavirus-related scenarios. So with those definitions, what are some likely applicable expenses that our current environment is, with the coronavirus, that our current environment is making available and could potentially be used for these types of payments? That could be medical expenses of the employee, not covered by insurance or otherwise. So that could be like co-pays, maybe incurred for coronavirus treatment. Health-related expenses other than medical expenses, so like over-the-counter medications. Dependent care expenses, so things like child care, tutoring expenses, especially if the employee's dependent is incurring those because of school closures, remote learning costs, homeschooling expenses, maybe even home internet, computer use for these education, for providing education at home, any other kind of educational materials, online subscriptions, etc. Expenses associated with working from home. So many people are working from home now, so that could be things like home office setup costs, computer, internet, printer, cell phones, maybe even increased utility costs on account of working from home. Transportation expenses due to work relocation. So maybe if you now have to do ride sharing and taking a taxi or Uber because of mass transportation closings, those could potentially be expenses. Maybe critical care and funeral expenses of an employee or a member of the employee's family who passes away due to the coronavirus. Maybe other living expenses due to an employee's known exposure. Things like hand sanitizers, disinfectant supplies, those kind of things. Now, it's important to keep in mind that there is no formal IRS guidance that's been issued yet on what a qualified disaster relief payment is specific to the coronavirus. So the items that I've listed are things that history tells us are likely to qualify. Some of these perhaps more likely than others. But keep in mind, and this is something to keep an eye on, especially if as an employer you want to assist certain employees, the opportunity to do that in a very tax-friendly way is likely to exist here, and the expenses that are actually going to count will probably be clarified here in the very near future. Thank you for listening to today's presentation. Please feel free to reach out to one of Shakespeare's financial planners if you have any questions.